Good Friday morning to you, everybody. This is Lee Gaus coming at you again from the offices of IFG Group here in Chicago. Today I want to talk about the model. You've heard me talk about the model. You've read about my model if you've read The Edge in the past. I want to give you a little better understanding of the model and what it is meant to do and where it really excels. Where the model really excels is telling us when a trend has changed and when the trend change may be a significant trend change, a long-term movement of value that provides greater than normal opportunities. So let's take a look at several commodities in the past. The first thing we want to look at is the coffee market. Now, back in January of 2014, around $117 a contract, the model went bullish. And I wrote about it at that time, didn't film about it, but did write about it. And then from $117 in January, it rallied into late April and topped out at $215.70. It took about a 3 or 4 week period, a rest period as I called it, and then hit its secondary and final top at $225.50. Now folks, that's about $108 a contract. Unbelievable move, a move that somebody could have gotten on and rode that move until there was nothing left. And that's where the model kind of excels. But then if we go forward, we take a look at in October of 2014, around $200 a contract, the model told us that the trend had changed bearish. And so around $200 in late October until today, as it was trading at $128.85 as we came in for filming, you can tell that we're looking at another $72 a contract going down the other side. So basically what we're talking about is almost, if you add the up move and the down move, almost $200 a contract that lasted, the move lasted and has lasted a significant period of time. This is where the model excels, in picking out those markets that may give us those significant moves. Now the other commodity we want to look at is the US dollar. Back in September of 2014, the dollar was trading at about 82.50 and the model told us that the trend had turned up. And of course today, the dollar traded par, 100. So that's like $17 or 1,750 points from the buy signal in September of 2014. We take a look at crude oil. Around the same time, September of 2014, the model told us to get bearish on or about $92 a contract. And of course, as we came in for filming today, it was trading at $45.50. Now, I also want to go the other way. The gold market, the model told us back in early March that the gold market up around 1,220, had turned into a long-term uptrend. And as we know, the market gave us a head and shoulder fake and is now trading lower at $11.55. The model was wrong. I point this out because not every signal we get is going to be a perfect or a correct signal. Every now and then the market will throw a head fake and will cause the model to err, as it did in the gold market. The point that we need to watch and make is to buddy up when the fundamentals and the model are pointing in the same direction and take advantage of long-term running trends that have potential dynamic moves, as did the coffee, the dollar, and the crude oil. Now, another trade that I have talked about for a while that just hasn't materialized has been the April cattle, April hog spread, which if you go back to the very beginning of that spread, it started out at about $28.50 premium cattle to hogs. And today, before we came in, it was trading at $93.90 premium cattle to hogs. And the very fact of the matter is, it may not turn around and give me a chance to recommend buying hogs and buying cattle before the April contract goes off the board. But it is something I'm going to be watching, because when it does turn, and if we can buddy up fundamental reasons for the turn, we're going to be recommending that spread. So when we take a look at it and you take a look at the model, what I'm trying to find out for you is what might be the big movers that the trend is going to last a significant period of time, where we can buddy up the fundamentals, justify taking positions in a long-term type of trend and looking for dynamic moves. Is it always right? As I've stated, no, it's not always right. But I've got a lot of faith in it. My model is better than Alan Greenspan's model, you know, that took us into the economic dumper in 2008. I've never been that bad. So when you take a look at what we're trying to do, understand what, you know, the function of the model and what the model is best at telling us. If you're a shorter term trader, that's wonderful. The model probably is not the best tool to use. If you're a longer term trader looking for the big dynamic moves and are well capitalized, let me repeat that, well capitalized, the model, I believe, in my opinion, has something very valuable to offer. So what I want to do now, folks, is I'm going to come back on Monday. Today's Friday. It's a key day for the model. I'm going to come back and film on Monday, and we're going to take a look and see if any commodities turned the trend from their present trend, and if we can buddy up fundamental reasons to get excited about that trend change, if any happen. And we'll also have a quick review of where the aforementioned commodities have ended up and where they might be looking come Monday. I hope you find this to be interesting. I'm real excited about this. I've worked on this for a lot of years. The individual that taught me this was a very successful trader, and I'm very grateful that he took the time to teach me the model. And I hope that you find it as interesting and as exciting as I do. Always keep in mind, trading futures, trading options on futures, and trading spreads is risky, not can be risky, is risky, and you need to be properly capitalized, and you need to understand the underlying risk you're assuming if you trade commodity futures. Again, this is Lee Gaus coming at you from the headquarters of IFG EFG here in Chicago, wishing you a great weekend and looking forward to talking to you on Monday.